Well, I think we should go ahead and get started here. Um, so we'd like to welcome everybody that's here. And we are really excited about talking about, and I'm going to give a pitch here for Stonehill. Stonehill, unlike many of the FMOs or whatever you want to call us around the area, we have multiple departments, multiple lines of business, and one of those is life insurance. We've had a number of agents who have asked us recently about final expense and things like that. And so we have asked John Maurer from Mountain CE to come in and help us. They do have discount programs for Stonehill agents, and we are going to be posting the code for that and everything out on it's called MedicarePlanDetails.com. It's a place where Stonehill puts important information that you just want to remember, and things we put out there, enrollment kits from the various carriers and everything, and it's just in a directory tree, so it's very easy to navigate and get what you want to if you don't want to have to go to the various carrier websites and navigate all their different designs and remember all this. So it's just an easy thing that's meant there for your convenience. And we're going to put how to get a hold of Mountain CE and everything out there so that you can do that today. There will be questions at the end of this. That's one of the necessities of taking the CE online like this. So those questions, and I haven't confirmed this with Nancy and Terry and John, but I imagine we'll do it the way that we've always done it, which is that John may let you know what the question is. My understanding is the state forbids him from telling us what the answer is, but then you'll receive instructions at the end, and either Terry from our office will be sending you the questions, or you'll be sending the answers to Terry, or I'll let John and Terry explain how all that goes. Without any more ado, let us go ahead and get started. John, take it away.
All right, thanks, Doug. Appreciate it. Everybody should be able to see my screen where it says Mountain Sea Insurance Training up at the top with our mountain goat. Everybody seeing that? All right, awesome. Well, again, thanks, Doug. Appreciate the opportunity to be with you and all the agents. So my wife and I own this company called Mountain CE. We've been doing it since 2005, and we specialize in helping people pass the state insurance exam, as well as providing continuing education for insurance agents. And I'll just, just wanted to be fully transparent here. I don't know everything about everything. I'm an insurance educator, and my main focus right now is helping people pass the state insurance exam. So I'm really sound on insurance fundamentals, and I have lots and lots of experience with all kinds of different types of insurance. And there might be some things that we talk about today, though, that you might know more than I know about it, and that's okay. So we're here to have a discussion and encourage you to share your experiences, your knowledge, as well as we go through the training. So this...
Good morning.
Hi. So this session is called Life Insurance Discussions, and it's going to last until a little bit before 12 is when I'll wrap things up. We need 50 minutes of instruction per credit. So this has been approved for 2 credit hours. And so doing the math, that's 100 minutes of instruction, which comes out to 1 hour and 40 minutes. So that means that we'll have some time at the end of class, where we're going until 12 o'clock, but we don't need the full up until 12 o'clock to get the 2 hours of CE. And so we'll have some time at the end for more questions and answers, and maybe talking about specific insurance company products during the CE discussion. One of the rules about CE is that we can't really get into details about particular insurance policies, particular insurance products, particular carriers. More so, we need to focus on the fundamentals of the different products, but not talking about specific company products. We can do that at the end of the instruction, because we will have time before 12 o'clock to do that. So this again has been approved for 2 CE credit hours for Utah resident producers. So we don't have it approved for any other resident producers. So if you are a resident of another state other than Utah, you're welcome to be in on the training, but the credit is only for Utah resident producers. Any questions so far about what we're doing, why we're here, the meaning of life, or any other tough questions?
So John, let me just interject here.
Yep.
We have a couple of employees here online with us who, well, maybe one that I've seen, who is from the life department. So I'd just like to encourage her to jump in if her expertise applies to whatever the discussion is. Okay, Lexi?
Sure. Yep, that would be awesome.
Yeah, definitely.
All right, cool. All right, so just to give you a heads up of what the program is going to consist of, the session is going to consist of this morning, is that we'll start out with a discussion about different types of life insurance. We'll talk about responsibilities of a life insurance producer. We'll talk about choosing the beneficiary, the choices we have with the beneficiaries. We'll talk about life settlements, not to be confused with settlement options at death, but we'll talk a little bit about life settlements, and then also settlement options at death. In other words, different ways that the life insurance death benefit can be paid. And then we'll wrap up things with the CE session on final expenses, the different options to pay for final expenses, what final expenses are, and different ways that people can pay for final expenses, and your opportunity to be involved in selling insurance that can pay for final expenses. One thing I'd like you to ask right now is that do you want to have a break halfway through, or do we want to forge ahead and get her done as quick as possible this morning, or would you like a halftime break?
Quick as possible is my vote.
So we've had 3 forge ahead.
All right. All right, very good. So unless I hear otherwise, we will forge ahead. We won't take a break halfway through. And so we'll get done with the CE, let's see, doing the math here. We'll get done with the CE instruction about maybe 10 minutes before, see, yep, 10 minutes before 12. All right, maybe yeah, quarter to 12 about is when we'll get done. Give her probably somewhere between 11:45 and 11:50 is when I'll be done with the presentation, and then we can talk product specific things at that point. All right, so you should be able to see what I'm presenting now. We're going to again focus on the types of life insurance, and one of the more interesting things related to life insurance, I think, is some people say, the only way to go with life insurance is term insurance. You got to buy term insurance because otherwise, it's just it's not a good deal for the customer if somebody buys permanent insurance. But then, others say, permanent insurance is the way to go. I'm going to assume here that everybody knows the difference between term insurance and permanent insurance. Am I correct on that? Or does anybody want a refresher on the difference? Are all of you involved in life insurance already, or not? Just want to get a feel for what your expertise is.
You can type a note into the message, the chat area, or you can just give your opinion.
Okay. All right, so got 2 responses so far. Any others? As far as, do you want, I'm going to assume here that we already know what term life insurance is. We already know what permanent life insurance is. Okay, thanks for all your responses. Keep them coming. All right. So, all right. So you all know what term life insurance is, what permanent life insurance is, which includes the whole life and the universal life. So I want to get your thoughts. You can either do so through your microphone, or you can put them in the chat box. What are your thoughts on what your experience is as far as selling term insurance? Have you sold mostly, those of you that have sold life insurance, have you sold mostly term insurance? Have you sold mostly permanent insurance? Both?
Only term,
Only term? Okay.
no whole life, no IUL, no investment tied to insurance.
Okay.
Term, term only.
Term only. Okay. All right. Some things in the chat. I have a client now 70 and retired that wished he had invested in life insurance, in other words, permanent insurance years ago. Another is only sell permanent insurance when including long-term care rider. Every situation is different. Yep. Depending upon age and both and need. So both is the response there. Term and permanent. Okay, sold them all. Both. Okay, another one is both. Both. All right. Mostly universal, some term, some whole. Obviously a market for both. Yeah, so all your answers are right. Because everybody, we all have different experiences. We all have different experiences with customers and so on. And the way I look at it is, is term better? Is permanent life insurance better? And here's how I look at it is that the one that's in place when death occurs, or when I should say, when there's a need for life insurance and there's life insurance in place, whether it's term life insurance or whether it's perm life insurance, and when it's meeting the need, that's the best one, right? Whichever is there when a family needs the life insurance is the best one, because when the life insurance company sends the check, or sometimes agents have the privilege of delivering the check personally to the surviving family members, do the people receiving the death benefit care? Do they care whether it was term life insurance or whether it was perm life insurance? They don't care. They just know that it was there in the time of need. All right. Another answer was term until I had a heart issue that will change your view. Yeah. So in my opinion, I'll give you my opinion is, young families, young people, especially young families, need lots of life insurance, lots and lots of life insurance. And it might be very difficult, of course, for a young family to afford the permanent life insurance. And so term life, of course, is very cheap, didn't say cheap, inexpensive for a younger person. So I think term life certainly serves a purpose for a young family. But then permanent is nice also, though, when a person gets older. At least some permanent life insurance is very helpful. And that we'll talk more about that more at the end of the session today, when we're going over final expenses and how to pay for final expenses. All right, and another response in the chat was they don't care, whether it was term life or permanent life, and they never complained it was too much when they received the check, when they received the death benefit. Good point. Good point. All right, so are you all familiar with the universal life? I know that some of you said in the chat that you have sold Universal Life. And I'm guessing that all of you are maybe heard of Universal Life at least, or maybe you're an expert at Universal Life, but maybe some of you maybe aren't sure what it is. So let's talk about it, because I'm guessing that not everybody maybe is an expert that's in class here. Maybe not everybody is an expert on Universal Life. So what is Universal Life? Universal Life is, in a lot of ways, is similar to whole life because it's considered permanent life insurance. It's permanent life insurance that grows cash value. But those of you that are experts with Universal Life, what's different about Universal Life versus whole life? Who'd like to share that with the rest of the group? No takers on that? All right. Well, I'll share then what, from my perspective, what's different about Universal Life is that it offers flexibility. Universal Life can offer flexibility in the payment of premiums, right? Because if you got whole life, if you're selling whole life, the policy owner is on a set schedule that here's your plan and you got to pay into this policy a certain amount each month. So whole life is more of a plan. But Universal Life, it offers more flexibility, so you can put more money in. If a young salesperson that's making a lot of money, maybe some months they're making lots of money, maybe some months they're not making as much commissions, and so that might be appropriate for Universal Life. With that is that in the months that this person has extra income, extra commissions, for example, can put more money into the Universal Life, and that's going to grow the cash value faster. It's going to provide potentially, in some types of Universal Life, provide a higher death benefit as well. There's also variable life insurance. We'll talk about that in just a moment. But when we're talking about Universal Life now, I'm just limiting it to fixed products. And yeah, with Universal Life, it offers flexibility. So I'll give you a real life example. My mother had a Universal Life policy, and she had put lots of money in it when she was younger. And then when she got older, she realized she had lots of cash value in the Universal Life policy, and she decided to stop paying the premiums. And because then the premiums are paid by the cash value. Eventually, though, after about 10 years of that, the cash value was gone. And then she wondered what to do with the policy, and she ended up canceling the policy. She didn't really need that life insurance anymore, and it served a purpose, but she let the policy go because she was at that point in her 70s. It would have been very expensive for her to put more money into the Universal Life policy, so she let it go. All right, and then with Universal Life, there's typically two options available. There's option A, sometimes called option 1. There's option B, also called option 2. And the difference is that with the first option, sometimes called option 1 or option 2, option 1 or option A, with that one, it's more like whole life where the cash value remains level. I'm sorry, the cash value grows, the death benefit stays level. But with the second option, Universal Life option 2, also known as option B, the death benefit can actually grow as the cash value grows. All right, any other thoughts or questions on Universal Life before we keep going?
Correct me if I'm wrong. With the Universal Life, can you adjust up or down the death benefit, and then by extension adjusting your monthly contribution, which actually is a premium?
Yeah, there's so many different insurance companies out there and different insurance products. Generally speaking, from what I've experienced, what I've seen with Universal Life, you got flexibility in the premiums, and then some, the second choice that I mentioned there, option B, also known as option 2, that one does allow you to increase the death benefit. So with the second option, as your cash value grows, so does your death benefit grow. With some options with universal life. That's based upon my experience. All right, got a request to repeat option 1, option 2 again. Yeah, so with option 1, it's kind of like whole life. Because with whole life, your cash value grows, and most whole life policies have a level death benefit. Doesn't go up. So option 1 is a lot like whole life in that regard. But option 2 is different because option 2, universal life, as the cash value grows, the death benefit also grows. That's the main difference between, from my experience with option 1 versus option 2.
Will a universal life, can it pay up the way a whole life will, or does?
I'm sorry, can you, you're saying, can it pay up?
Well, is it like, does it function the way a paid up whole life would function? In other words, you pay for so many years and then you don't pay premiums anymore. It's a self-supporting policy.
Maybe so. Maybe so. With universal life, as you get older, the cost of the insurance keeps going up, right? And so, like in the case of my mother, she, as she got older, the cost of the insurance kept going up and up and up and up, because underneath the covers in a universal life policy, the insurance portion is just it's annual renewable term insurance, which keeps going up for an older person. And so so what you said is maybe true. If there's enough cash value in there to forever be able to pay it, great. But as a person gets older, the cost of the insurance keeps going up and up and up and up, and it might run out of cash value because and if it runs out of cash value, then the policy ends. All right, we could, if you have additional questions on universal life, we can talk after class, but we gotta keep going. So now let's talk about fixed, indexed versus variable. So fixed life insurance is just you know what that is. It's like most term life insurance is fixed, and a lot of whole life is fixed, and some universal life is fixed. And so when we say fixed, that doesn't mean that, like the cash value doesn't grow, because in fixed policies that have cash value, the cash value grows, but it's called fixed because it's guaranteed. Fixed means it's guaranteed. Guaranteed what? Well, guaranteed as long as the insured pays the premiums, as long as there's money in the policy to keep it going, it's going to be guaranteed to pay a death benefit. And with like whole life insurance, as long as the insured keeps paying the premium, as long as the policy owner keeps paying the premium, the policy is going to be guaranteed to pay a death benefit. And if it has cash value, the cash value can never go down. It can only go up. That's a fixed product. On the other end of the spectrum is variable. And I know a lot of you are already familiar with what we mean by variable products, also known as securities. With the variable product, that means that when we combine a variable product with life insurance, that means that as long as the policy is active, it's guaranteed to pay a death benefit, but the cash value could go down in a variable product. The cash value can lose money if the variable product, the variable life insurance, is tied to a stock market index like S&P 500, for example. Like last year was a horrible year for stocks, and so somebody with a variable life insurance policy last year would have experienced a decrease in cash value, most likely. All right, and then in the middle though is indexed. Some of you maybe are familiar with index products. Some of you maybe aren't familiar with index products. So index product is kind of in the middle. It's kind of has some characteristics of fixed, some characteristics of variable. So with the index product, it is the growth of the cash value is tied to a stock market index, for example. And so in good years, when the stock market is going up, the index product is going to do well. The cash value is going to grow. But what about when the stock market goes down, like last year? What happens to the cash value in an indexed product? Anybody know? Anybody know? All right. A lot of you are saying it goes down. No, it doesn't. So with an index product, even though the growth can be tied to a stock market index, for example, S&P 500, with an index product, the cash value cannot go down. It can't go down. It's guaranteed to not go down. It might not go up last year, but it's guaranteed to not go down. So that's the difference between index product and variable product. And you might say, well, how's the insurance company make out how can the insurance company do that? How can an insurance company provide growth when the stock market goes up, but when the stock market goes down, the cash value doesn't go down? Well, the house wins, like Vegas, the house is going to win here. So how is the insurance going to do that? Well, when the stock market goes up, and we're talking about an index product, when the stock market goes up, there's going to be a cap on how much gain the insurance company will give to the policy. So if the stock market goes up 25% in a particular year, the growth isn't going to be 25% on the cash value. It's going to be a lesser amount. It's going to be, maybe I'll just pick a number out of the hat here, 8% or something like that. There's lots and lots of different formulas insurance companies use to determine how much growth is. All right, so index, as mentioned in the chat, have caps on the gains. Yep, that's right. So it might be, can never be more than this, or it's going to be a percentage of the gain, or there's all kinds of different ways of doing it. But so is index product a variable product or a fixed product? Well, the state of Utah, the state of Utah government website on security says that index products are deemed to be fixed products. They're fixed products. That doesn't mean it stays the same. It means that it's guaranteed to not go down. So an indexed product is also a fixed product, but not variable. All right. All right. Any thoughts or questions there? Difference between fixed, indexed, and variable. Anybody want to chime in on your experience with it?
Hi, this is Sharu. So regarding the index universal life, I think there's one thing just we need to pay attention to it. So even they said it's it won't go down. There's a $0 floor. The thing is, it doesn't guarantee you're gonna have any gain because usually the company credit the interest to your account is based on the point to point the method.
Mm-hmm.
So it basically is you compare the 2 days, like your policy, the beginning day, the anniversary date, and 2 days. If like you choose different indexes, and they'll measure that. If see how many percent you can gain, then there's no credit to your policy. The thing is that there's a cap rate, and the cap rate the company can change it every year. So there's no guarantees there at all.
Yeah, with index product, yeah, there's no guarantee of getting any gain, but there is a guarantee of not losing.
Yes, it's just there's a $0 floor. That's it, right?
Yep.
And so the average return, it doesn't apply to your policy. So your policy only realizes that annual anniversary date, the point to point, and then they measure the interest. See if you have any gain, then you gain certain point. but there's a cap there. Let's
That's
say
right.
S&P, they have like a 20%, 25% in the return, but on the personal accounts only has like a within the cap rate, the return.
Yeah, and you're absolutely right. And it can get really complicated. You know, different companies have different ways of doing it, and there's so many different formulas to so many different ways of doing it. And it can get pretty intense as far as figuring out how much gain there's going to be in a particular year if it's an index product. But I'm a simple man with a simple message, and so with an index product, just know that you can participate in stock market gains when the market goes up. But the nice thing about an index product is that you can't lose when the stock market goes down. All right, some comments that just came in. Over time, variable life will generally build enough cash value to have covered the cost of all the premiums paid. Okay, yeah, it can. And then any strategies for using cash value besides paying the premiums? Well, yeah, I mean, cash value can be used for all kinds of things. It can be used to pay for long-term care, you know, nursing home care. It can be used for paying for college tuitions, all kinds of things. In addition to paying premiums. So universal life policies do have that feature where if you have lots of cash value, you can stop paying the premiums and the premium will be paid by the cash value. So just one more thought here on fixed versus index versus variable. In order to sell variable products, you got to have a securities license, and that's regulated by the federal government and also the state of Utah. So you need a life insurance license, of course, plus a securities license from the federal government to sell variable products. But fixed and indexed are still, you just need a life insurance license for those products. All right. Question, do you have illustration software for universal life? So, you know, that's going to come from the insurance companies are going to have illustration software for universal life. All right, so just wanted to briefly make sure we all know about the tax advantage of life insurance. So, you know, life insurance is an amazing product because the death benefit is always 100% tax-free. So you're probably already telling your clients this, but if some of you are new to insurance, new to life insurance, please make sure that you tell your clients that life insurance is tax-free death benefit. That's huge. That's a huge thing. You know, somebody can put their money into stocks and bonds, or stocks, and make all kinds of money, but you could have to maybe pay tax on the gain when you're putting the money in the stock market. Of course, you can use IRA. There's IRAs and 401ks but in order to put money into a 401k and IRA, you got to be making money with a job, and there's limits on how much tax advantages you can get with our 401ks and IRAs. But with life insurance, the death benefit's 100% tax free. Okay, all right, and so as pointed out by Doug earlier, there is going to be a test later to make sure that you attended the class. And so just want to say that you never know what might be on that test, right? So according to securities.utah.gov, equity index life insurance annuities are deemed to be what? I just mentioned that a moment ago. So you can answer in the chat what you think the answer is. Equity index life insurance, as well as annuities, are they variable products, securities? Are they non-guaranteed products, or are they fixed products? According to securities.utah.gov. Okay, you got 3 answers so far. All of you are right. Anybody want to say the answer?
We're just a really shy group.
Yeah, I guess so. Don't be bashful. All right, so most of you that answered in the chat are correct. So remember that equity indexed life insurance are fixed products according to securities.utah.gov. So does that mean that means you only have to have a life insurance license to sell those products? You never know what might be on that final exam that you have to take to be able to get credit for the class. You never know. All right, any questions on that? Okay, let's talk a little bit about responsibilities of insurance producers. So first and foremost, there's strict rules about advertising when we are selling life insurance products. And guess what? When we're advertising insurance products, life insurance products, we have to say that these products are what? That they are life insurance products. We can't try to pretend or trick people or mislead individuals into thinking that life insurance is something other than what it is. We got to call it what it is. We have to clearly identify the name of the insurance carrier that's underwriting the policy, that's that we're representing. We got to clearly state the type of policy that we're selling, got to clearly say that it's an insurance policy. So just goes without saying. But that is a responsibility that we have as life insurance producers. There's also, we got to be aware of the buyer's guide. The buyer's guide. And so, and I'll bring this over here for you. There's rules that we have to follow regarding the buyer's guide. And here we go. So this is taken from Utah Insurance Rules, or from utah.gov. So a buyer's guide is something that we have to provide to the clients. And the language that's contained in the buyer's guide has to have been created from the National Association of Insurance Commissioners, the NAIC. And just want to point out a couple more things. The insurer shall provide a buyer's guide through an agent, for example, and either a policy summary or a life illustration that is in compliance with the state rules. And so the buyer's guide the insurer shall provide a buyer's guide to any prospective purchaser upon request. So that's a requirement. Got to know that we have to provide buyer's guide. And so the carrier, should be able to provide you with those. If you don't have a buyer's guide, the carrier should be able to provide those with you. All right, got a question that just is in the chat here, explaining the line between needing a securities license and not needing it for fixed, especially index universal life. All right, so it's my understanding, if we go back to that real quick. Whoops, sorry about that. I messed up. Well, I'll just, so we'll just say it here. So, so there's fixed products, there's index products, there's variable products. So in order to sell variable products where the client could lose money, could lose cash value, a person not only needs an insurance license from the state of Utah, but also has to have the variable line of authority on the Utah insurance license and got to get a license from the federal government. It's a securities license, also as a variable license, in order to sell variable products. The other products, fixed products and index products, you only need a life insurance license from the state of Utah. Did that explain that? Okay, very good. All right, so back to the buyer's guide. Got to provide it, and to the client, it's a requirement. Okay, then in addition to a buyer's guide, there's also a policy summary that we need to be aware of. So bringing up some information from state insurance rules. I'm just want to go right to the source, from the source, and that is that when we are selling life insurance, we do need to also provide a policy summary. So policy summary means a written statement describing only the guaranteed elements of the policy. So I'd encourage you to remember that. Policy summary is different than an illustration. A policy summary only provides guaranteed elements of the policy, only like the guaranteed death benefit amount at points of time in the future. What's the death benefit going to be, at this point in time in the future? What is it right now? What's it going to be 5 years, 10 years down the road? And what's the cash value going to be 5 years, 10 years down the road? Guaranteed amount. Could be more cash value than the guaranteed amount, but policy summary only provides guaranteed amounts, not projected amounts, not non-guaranteed amounts. Okay. So the name and address of the insurance producer, or if no producer is involved, a statement of the procedure to be followed in order to receive responses, inquiries regarding the policy summary have to be included in the policy summary. So here is important information, again, from Utah State Insurance Rules. The insurer shall provide a buyer's guide that we just talked about. So a buyer's guide is a generic document that, what is term life, what's whole life, what's universal life, what's cash value. Buyer's guide explains the basics. It doesn't have any details about policy information, but a policy summary does have the details of the policy being sold. And it's saying here that the insurer, through an agent, can provide or shall provide a buyer's guide and either a policy summary or a life illustration. Don't have to do both policy summary and a life illustration. It's one or the other. Policy summary provides guaranteed amounts, guaranteed death benefit, guaranteed cash value amounts. Illustration can provide that information, but also illustration can include non-guaranteed amounts. Like, if market conditions stay the same, then your death benefit will be this much at this point in time in the future. Your cash value will be this much. That would be on an illustration. So to summarize, the insurer shall provide a buyer's guide and either policy summary, which only contains guaranteed elements, guaranteed amounts, or a life illustration, which will provide guaranteed amounts as well as projected amounts. All right. Any questions on that about a buyer's guide, policy summary, life illustration? All good? Okay, we already talked about buyer's guide, policy summary, illustration, and then replacement. So I'm sure a lot of you are already familiar with the idea of replacement. What does it mean to you? Those of you that have experience selling life insurance, what does replacement mean? Just trying to get some audience participation here. What is a replacement? All right, thank you, Lowell. All right, Lowell says replacing a current policy with a new one. Okay, so let's suppose that I bought a life insurance policy 40 years ago when I was a young adult. And was I younger or older 40 years ago? Stupid question, right? And was I healthier or less healthy 40 years ago? Well, most of us, maybe not all of us, but most of us get less healthy as we get older. Our blood pressure might be going up, our cholesterol might be going up, our risk of this disease, or maybe I've already had this disease and so forth. So the point is that I might be locked in at a younger age, and I might be locked in at a better health when I bought that policy 40 years ago than I am today. But I'm considering getting rid of my old policy and buying a new one because there's a insurance agent that's been bugging me trying to sell me life insurance. Like, get rid of that old policy, it's no good. Buy a new policy because, what do you want, that stupid old policy? It's no good. But in my situation, it might be better to keep the old one. Might be better to keep the old one instead of buying a new one. Why? Because I was younger and healthier when I bought it a long time ago. So a lot of you already know that. Maybe some of you, though, didn't know that. And so when we are selling life insurance, and we always have to ask on the application, is this policy that we're trying to sell you here, is this one going to replace, get rid of any other policy? That has to be on the application. And so if there is other life insurance, and if that other life insurance is going to be replaced, then we have to do extra work. We have extra paperwork to do. And therefore, we have to make sure, I mean, the carrier is going to help you with that, of course. The carrier is going to give you the proper forms that you need to have filled out, and it has to be signed by the prospective buyer to make sure that the buyer of the new life insurance policy fully understands that, take a second look at this. Are you sure? Are you sure you want to do this? Are you sure you want to get rid of that old policy and buy the new policy? Because, it might be better for you to keep the old policy. All right, some comments that came in. Appreciate all your comments in the chat. Don't cancel your, we should always be telling the clients, don't cancel your current policy until your new policy has been approved and issued. Yep. Larry says premiums are based on age. Yes, they are. Absolutely. And that's why it might be better to keep the old policy. And most replacements tend to be a new term policy when the term of the previous term policy ends. Okay. Yep, there can certainly be, and quite often there are replacements with term policies. All right, any other thoughts or questions on replacement? Okay, we want to point out another thing about responsibilities related to life insurance producers, and that has to do with the Utah Life and Health Insurance Guarantee Association. Have you all heard of that before?
Mm-hmm.
Everybody heard of it?
Yes.
Okay. Thank you, Jay. All right. So far in the message chat area, looks like kind of half and half, but looks like there's more no's than yeses. So there's looks like there's quite a few that maybe about half of you, or maybe a little bit more than half of you, aren't familiar with the Utah Life and Health Insurance Guarantee Association. So let's talk about it. So this it's not really part of the state government. It's not a government fund technically, but it exists because state law says it has to exist. And so essentially, in a simple way of explaining, it's just there to pay for claims if an insurance company becomes bankrupt, insolvent, unable to pay claims. It's a safety net. And so all insurance companies that sell life and health insurance in Utah have to belong to the association, pay money to the association, so that in the unlikely event of an insurer insolvency, a carrier insolvency, there's funds available to help pay claims. Yep. Another way of saying it is protects consumers against carrier default. Thank you, Bill.
I believe it has a maximum. I think there's a lid on it. 500,000, I think, is the max.
Right. Yep. And I was going to bring that up at this time to help us with that. So here's the website. So the website is Ulhiga, ULHIGA.org is the name of the website. And so it tells us, what the purpose of it is and so on. And so there is an area here where it tells us the minimums, or the maximums amount paid. Where is that? I think it's right here. It's under FAQs, I think. Fully protected here. Yep. So I'll try to make this a little bit bigger so you can see it better. So this, the Guarantee Association, it says if your insurance company fails, the maximum amount of protection provided by the Utah Association for each type of policy, no matter how many or what type of policy. So it's for each type of policy. But these amounts here are per insured life, not per policy, but per insured life. So life insurance death benefit is 500,000. Cash value is guaranteed up to 200,000, and annuity benefits are guaranteed up to $250,000. So it's important to know that what the purpose is of the association, and know that it's not going to pay millions or even $1 million. It's going to, there's a limit on death benefits of the 500,000, 200,000 on the cash surrender value on life insurance policies. And another thing I want you to know about the Guarantee Association is this: the advertising prohibition. So now that some of you didn't know about it and I told you about it, now I have to tell you this, is that I'll just summarize what this is saying here, is that when we are selling life insurance and annuities, we are not allowed to use this as a way to induce people to buy the insurance. We can't advertise the existence of the Guarantee Association. It's against the law. Why is that? I'm thinking that the reason why we can't advertise it when we're trying to sell insurance is because, like, if I'm out there saying, you know, buy John's policy, it's the best, it's guaranteed by the Guarantee Association, it's kind of implying that maybe other policies aren't guaranteed by the Guarantee Association. And another thing to remember is that there's limits as to how much the policy, you know, only $500,000 on a death benefit, for example. A lot of people need more life insurance than that. And so maybe that's another reason why there's a state law against it, because there's a limitation on how much it'll pay. All right, anybody have any thoughts or questions about the Guarantee Association? Did everybody all of you that were familiar with the Guarantee Association, were you aware of the advertising prohibition?
Hi, John. This is Sharu again. This is regarding this the Guarantee Association. Some people, they use this. They say, hey, you know, you just buy some like the small companies, but their premiums cheaper, and they'll never bankrupt. So, what do you think about this comment?
I didn't fully understand the comment. Could you say once more?
Okay, so so since we have the Guarantee Association, right? And then, do you think the insurance company, they can bankrupt?
Mm-hmm.
What's your thoughts?
You're asking me if I think that an insurance company can go bankrupt? Is that?
Yeah.
I'm sorry. So you're asking, like, what's the likelihood of an insurance company becoming bankrupt?
Yes, because we have the Guarantee, the Guarantee Association as a backup. Then that's like some agent, they say, okay, you can just choose the cheaper, the smaller company. Usually they have like a cheaper premium, and they say, okay, you know, they will never, this company, small company or insurance company will never bankrupt. Have you heard about that?
Well, there's, you know, it doesn't happen very often. There was a few years ago, I don't know, maybe 5 years ago, maybe more now, 10 years ago, where a health insurance company went bankrupt in Utah. It doesn't happen very often. So, but there are independent rating services that can measure the financial strength of insurance companies, like AM Best is probably one of the best known. Have you ever heard of AM Best?
Yes.
So that's you know, a way of measuring the financial strength of an insurance company. So I would just say, you know, it's insurance companies don't go bankrupt very often, but it is, you know, financial strength is important, and so if a customer is concerned about that, I would refer them to one of the independent rating services like AM Best, and Moody's is another one. Standard & Poor's has a rating service for insurance companies. There's one I think called Fitch or something like that. There's about 5 that do that. So that's how I would handle that situation.
Thank you.
Thank you. All right. Any other thoughts or questions? All right.
Doug, you said something about somebody explaining a guarantee association.
What was that?
So I put a chat I put a message in the chat feature. I was trying to get Lexi to weigh in here. So when I see the prohibition to advertising, for me, advertising is a very specific form of communication. And it's not the same thing as sales speech or explanations by agents to beneficiaries. And so I was wondering, since it's advertising prohibition, that does not prohibit an agent sitting face to face or talking to a prospect over the phone to describe the association, right?
Well, are you seeing what I'm sharing here with you? Oops, it went away. Shoot, I'll get it back. One moment. Here we go. So it says, this is right from state law. It says a producer. It says a producer may not make, publish, disseminate, circulate, place before the public, or cause directly or indirectly to be made, published, disseminated, circulated, or placed before the public in a newspaper, magazine, or other publication, or in the form of a notice, circular, pamphlet, letter, poster, or any radio station, television station, anyway, an advertisement, announcement, statement, written or oral, any statement, written or oral, which uses the existence of the association for the purpose of sales, solicitation, inducement, to purpose any form of insurance for which the guarantee association provides coverage on this part. So I don't know. To me, it seems pretty clear.
For me, that's very clearly directed at communication to the public. It's very much marketing, advertising communication, and it's not sales communication, which is
I
one.
agree with you on that, Doug.
Okay.
Yeah, I guess. Yeah, I don't know. Yeah, maybe you're more familiar with than I am, but it's I don't know. It seems pretty clear about solicitation for a purpose of a solicitation, a statement.
Well, so there's
the key language there is for the purpose of sales or solicitation. But if you're face to face with a client, and that client's worried about an insurance company's ability to pay in the event there's a claim, you're going to have the right to tell them, well, in the event that happens, this is how you're covered. And I think you would be obligated to do that.
Yeah. It's unfortunate, I guess, that the state law says it this way. They maybe should be clarifying it more if that's the case. I'll see if I can get a hold of somebody at the state insurance department and get a clarification.
okay.
Right. Very good. Thanks for the discussion on that. All right. All right. All right. So now let's talk about beneficiaries. And so, of course, individuals can be named as a beneficiary in a life insurance policy. It's a very common thing. So we can name the person by the person's exact name. So one individual or many individuals can be the beneficiary. Of course, then also classes of people can be a beneficiary. So like, for example, the children of this person and this person can be named as a class beneficiary designation. And so, and then it becomes a question about per stirpes or per capita. So per stirpes means bloodline. So like if an individual is named is part of the class and that person dies, if it's a per stirpes designation, then it's going to go down to the next generation, that person's heirs. But per capita means if that person is gone, then there's that person's heirs are not going to get anything. So that can be true for both individual beneficiary designation or class designation. So the nice thing about a class designation, I guess, is that if there's more people that join that class, then they will be included in the beneficiary designation without having to change a policy. So just be aware that individuals can be named or classes can be named. And then, of course, there's succession. And that means that there can be a primary beneficiary designation, or multiple people can be named as primary beneficiary. And then if no primary beneficiary is alive at the time of death, then it's going to go down to the contingent beneficiary. There's a third layer called tertiary, I think it's called. And so you're going to go down all 3 layers. If there's no primary beneficiary, it'll go to the second one, the contingent beneficiaries. If there's no contingent, then it goes to the 3rd level. Okay, want to point out the common disaster clause. Have you ever heard of that, anybody? Common disaster clause, also known as simultaneous death.
Husband and wife dying at the same time.
Right. Yep. So, yeah. So if like there's a car accident where, you know, a couple, the heads of the household die in a common disaster like a plane crash or car accident, tragically at the same time. So there's a law in Utah called the simultaneous death law, which says that if you know, if both the insured and the primary beneficiary, like, you know, it's common, like one spouse will name the other spouse as the primary beneficiary in a policy and vice versa. So if both the insured and the primary beneficiary die in a common disaster, like a car accident, then it's going to, state law says that it's automatically going to be assumed that the primary beneficiary died first, even if the primary beneficiary didn't die first, as long as it happens, the death of the second person happens within 5 days. So why is that important? Why is that important? Because if it wasn't for this state law called simultaneous death law, also known as common disaster clause that we see in with how life insurance works, if it wasn't for this law, what could end up happening is that, you know, if the first, the insured dies at the scene of the accident maybe, and then maybe the primary beneficiary dies 2 days later in the hospital from that same accident, what could happen there is that the life insurance company is obligated to pay the estate of the primary beneficiary instead of going to a contingent beneficiary. Everybody follow that okay? So if it wasn't for this law, this rule, this law, well, what could happen is if the insured dies first, then technically it's whose money is it? Well, it's the primary beneficiary's money. And so the insurance company is going to be obligated to provide that money to the primary beneficiary. But if the primary beneficiary dies 2 days later, then if it wasn't for this law or this rule, what would happen is that the estate of the primary beneficiary would get the money and would have to go through probate instead of going to the contingent, the second beneficiary. But common sense prevails because of the common disaster clause. And, you know, hopefully, thankfully, this doesn't happen very often to your clients, but might be good to be aware of, because common sense is going to prevail in that situation. So even though technically maybe the insured died before the primary beneficiary, the death benefit is going to get paid to the contingent beneficiary, which is going to follow the wishes of that family.
It will only happen once.
Well, hopefully it never happens. All right, so minor children. So and I apologize, I don't have the ability to see the chats anymore. They are hiding somewhere. Apologize for that. So if the chats are coming in, maybe Doug or somebody could read the chat messages. But is it a good idea for minor children to be the beneficiaries on a life insurance policy? What
Not
you
sure
think?
they can.
Well, you know, if the insurance agent doesn't know what they're doing and they put down the individual's names of the minor children on the application, or, you know, mistakes can happen, right?
Great. So several of the agents have jumped in here, John. So
Uh-huh.
looks like 4 of them have said they cannot, and one of them said that they should name a trust.
Yeah, because, you know, if a mistake is made, you know, I totally agree with that, Doug. You know, but if a mistake is made and minor child is the beneficiary of a life insurance policy, the insurance company won't, you know, give the money to the minor child, of course. And so going to go through probate, right? So just want to point that out, that, you know, especially for the newer agents out there, that we should never have minor children as a beneficiary of a life insurance policy. It's bad. That would not be good if that happened. All right, and as mentioned, a trust, of course, is a really good way to go when we have minor children involved. So a trust can be set up by an attorney to own a life insurance policy. A trust can also be the beneficiary of a life insurance policy, and then the executor, whoever is managing the trust, the trustee, the one who is responsible for executing the trust, then that person is going to be responsible making sure that the money is used properly for the minor children. So just a reminder that when there's minor children involved, the best way to do it is to have an attorney create a trust. The trust can own the life insurance policy. The trust can be the beneficiary, and then the money will be used properly for the children. Any comments, questions on that? Okay. And also, as I mentioned a moment ago, a trust can own a life insurance policy. Why might that be a good idea? You know, even if there's no minor children involved, why might not that? Why might it still be a good idea for a trust to own a policy? Because then, because like, let's suppose, I'll give you a situation. Suppose I am really wealthy. I'm not really. I mean, I'm okay, but I'm not, you know, off the charts wealthy or anything. But let's suppose I've got $50 million of assets, and I die, and I have lots of life insurance as well. So what can happen here is that since if I own a life insurance, if I own my own life insurance policy when I die, if I personally own my own life insurance policy when I die, even though the death benefit might go to the little sisters of the poor, it doesn't matter where the death benefit's going. If I own the life insurance policy when I die, that the worth of the life insurance policy, the death benefit, can be included in my estate, which could be subject to estate taxes. So that's another reason why, for people that are very wealthy, it's a good idea maybe for a trust to own a life insurance policy instead of that person owning the policy personally. All right. Any questions there? Charities can be another beneficiary on a life insurance policy. And then the default is the estate. Right, so how do we define estate? The word estate here is defined as anything a person owns when that person dies. That's what I mean by an estate. So if I have life insurance and I die and there's no beneficiary alive at the time of my death, where's the money go? Where's the death benefit go? If there's no beneficiary alive when I die, where's it go? It goes to my estate. goes to my estate. And somebody tell me, is that a good idea or a bad idea? Is it a good idea or a bad idea for the estate to be the beneficiary?
Well, if it goes into probate, it's a bad idea.
Yeah, of course, it's going to be a bad idea for a death benefit to be payable to the estate, because it's going to have to go through probate, and we always want to try to avoid probate, right? Probate's not good for assets to have to go through probate, because it could take a long time. It could take months, it could take years for it to get settled. And now my death benefit, people are going to be fighting over my death benefit maybe. And that's not good. It takes time and also lots of money, lots of attorney fees, court fees, when money is going through probate. All right. Any thoughts or questions there about beneficiaries? Anything anybody would like to add from your own personal experiences? Anything in the chat, Doug?
No, it's quiet, though people may be typing something.
Oh.
John, this is Sharu. So regarding the common disaster clause, could you please explain that again? I didn't really get it. So
Okay.
this is regarding like a primary beneficiary and the contingent beneficiary. They both died within 5 days, right? And then okay.
Yeah,
This
I'll
is
go through a little example here to help us make sure we understand how that works. All right, so let's suppose that let's suppose there's a couple, and let's say Bob and Betty. So I'll make it bigger so we can see it better. So Bob is the insured. Let me know if you can't see this. I'll assume that you can see it. I'll just make it a little bit bigger. So Bob is the insured on the policy, and let's say Betty is the primary beneficiary, and then Billy is the contingent beneficiary. So just by looking at this situation, it's clear that, if Bob dies, then Betty is supposed to get the money. But if Betty dies before Bob, then this family's wishes are clear here that, they want Billy, which is maybe an adult child, to get the death benefit, right? That seems pretty clear in this, what we see here. But so what could happen is if Bob and Betty die in a accident at about the same time. So let's go through a scenario. So like Bob, well, let's say that, Betty dies first in an accident, and then a little bit later, then Bob dies a couple days later. So by the time Bob dies, there's no primary beneficiary, and the death benefit is going to go to Billy, the adult child, right? Which would be what the family would want. But what if, the idea here is that what if Betty were to die first? Betty dies first. Or then if Betty dies first, what I just said is that then Billy will get the primary, will get the death benefit. But what if Bob dies first? So Betty doesn't die first, but instead Bob is the one who dies first. Then the primary beneficiary will get the death benefit. Okay, so let's go scenario. Bob dies instantly in the car accident.
Hey, John?
Yeah.
So I'm wondering if you can work into this conversation something that Bill Turner asked. He said, please discuss personal representatives, parentheses, executors, and the positives / negatives between attorneys, banking institutions, and family members.
Well, that would be a different topic, I guess. So let's finish this one up first. So, okay, so in the case of Betty dying, Bob dies first, then really technically, who should get that money? Betty, the primary beneficiary, should get that money. Betty, the primary beneficiary, should get that death benefit, right? It's her money. So even though she hasn't received it yet, legally, she has rights to that money. It's her money. But now she dies 2 days later after Bob has died. You know, the family would want Billy to get the death benefit, right? But it wouldn't work if it wasn't for the common disaster clause, also known as simultaneous death law. It wouldn't work that way because Betty's estate would get the death benefit, which would have to go through probate, and maybe Billy would never get the money. If Billy eventually gets the money, it's maybe going to be a lot less because a lot of it got eaten up by probate. So the whole point of all this is that in a situation where the named insured on the policy and the primary beneficiary die in a common disaster, it doesn't really technically matter who died first, who died second. It doesn't matter. Common sense is going to rule the day. And if Bob and Betty die in a common disaster, an accident, it's going to be Billy in this example that's going to end up with a death benefit, which is going to be, meeting the wishes of this family. All right. So that other question, Doug, that kind of sounds like something an attorney could handle. I don't know. So you talk about personal representative versus what?
He said, and you can actually say that this is outside of the scope. He says, please discuss representatives, by that he means executors, and the positives and negatives between attorneys, banking institutions, and family members.
As far as beneficiary goes? That's probably what the context is of it. I do have, so I'm guessing that's what he's talking about, is like who should be the beneficiary, like a personal representative or attorney, a funeral home, or who should be the beneficiary, I'm guessing, is what the question is related to. But we will talk, when we get to the final expense portion of the class, we can go over some of those things. But I'll just, I'm not an attorney, so some of those questions might be best for an attorney. But I'll do the best I can when we get to that point in class. So here is a question. You never know what might be on that final test. If the deceased estate is a beneficiary of life insurance policy, it will result in the death benefit having to do what? You want to answer in the message chat area, you can. Or if you want to blurt out the answer, you can.
Lots of answers coming in.
Are they all the same answer?
Pretty much. Yeah. 3.
Okay. 3. Yeah. So if the deceased estate is a beneficiary life insurance policy, will result in death benefit having to go through probate. And so that points out the fact that it's really important not only to sell somebody a life insurance policy, but that policy needs to be serviced. It needs to be serviced. What we mean by service, like check in with the insured, like do you have your beneficiaries up to date? Are all your beneficiaries still alive? Do you still want these people to be the beneficiary of the life insurance policy, right? Because that can be a mess. And it happens more often than it should, that when the insured dies, there's no beneficiary alive to accept the death benefit. It goes through the estate and probate. So again, the first answer is false, because life insurance death benefits are not subject to income tax. That's a really important thing to remember. All right, any other thoughts or questions before we keep moving? Okay, the next segment here is regarding life settlements. Not going to spend too much time on this. Just want you to be aware of what they are. This is life settlement is not to be confused with the settlement options when a person dies. That's not what we're talking about here. Instead, we're talking about life settlement, meaning when somebody has a life insurance policy and that person who owns the life insurance policy doesn't want it anymore, doesn't need it anymore, and wants to sell it for cash. Sell it for cash. And so is that allowable? Can somebody just sell their insurance policy for cash? Yes, it is. And so there, when life insurance is being purchased, there needs to be an insurable interest. The one who's buying the insurance policy must have an insurable interest in the life of the insured. There's got to be emotional connection or financial connection of some sort. Insurable interest must be present at the time of the policy being purchased. But later on, it is possible for a person who owns a life insurance policy to assign it to somebody else. Why? Because life insurance policies have what's called an assignment clause, allowing the owner of the policy to give it to somebody else. The policy could be given to a charity, it could be given to a family member, it could be given to a trust, or and like for estate planning purposes, remember I talked about a moment ago that it might be a good idea for a wealthy person not to own his or her own life insurance policy, because then it could be part of the estate if a person owns the life insurance policy at the time of death. There's an assignment clause in life insurance policies that can allow the policy owner to assign it to somebody else, and that somebody else does not have to have an insurable interest. The insurable interest only needs to be present when the policy is first purchased. All right. Any questions on that so far? Okay. All right, so now there's different types of life settlements. One is called a senior settlement. This is available for seniors, people that are over a certain age, and different senior settlement companies might do it different ways, but generally like you got to be over 65 or 70 or something like that in order for this to work. The insured has to be over a certain age in order for this to happen. Typically like 65 maybe, give or take. And so with a senior settlement, it's like, suppose I've been, putting money into this policy all these years and it's got cash value now, or maybe it's a term policy and it doesn't have cash value. And, my kids are gone and I don't really need this life insurance. Maybe I have different life insurance, other life insurance, or maybe I don't feel like I don't need life insurance because I have sufficient assets. And I just want to get rid of it. I want to get some cash for it. I could, if it's cash value, can, surrender the cash value with the insurance company, get the cash value that way, or I could maybe sell it for cash. And then the company that buys my policy is going to name themselves as a beneficiary immediately, and then they're just hoping that I die, because then they'll get the death benefit when I eventually do die. All right, and then there's another variation of that is called a viatical settlement. This is specifically for a person who is terminally ill. And so if I have a life insurance policy, I become terminally ill, maybe I need cash to pay some bills, to maybe spend time with my family, and I want to travel a little bit before I can't travel anymore. So viatical settlement specifically it's a life settlement specifically for somebody who's terminally ill. But the thing about the viatical settlements is that they became popular in the 1980s with the outbreak of the AIDS disease. But more recently, life insurance companies have added these living benefits or accelerated death benefit riders to policies, and it's my understanding most life insurance policies today have accelerated death benefits, or also known as living benefits, which could pay the death benefit early or part of the death benefit early if the insured becomes terminally ill. So therefore, the need for these viatical settlements are not as great as they used to be because of the accelerated death benefit riders now that we have in life insurance policies. All right, and then just one more quick little thing: stranger originated life insurance. This is a scam. Stranger originated life insurance is a scam where somebody who is up to no good gets a person, usually an older person, to buy a life insurance policy in exchange for a free gift, and the one who's committing the fraud is going to pay for the life insurance policy, is going to get the life insurance policy assigned to that person soon after the policy is purchased. It's illegal, but it is something to be aware of. It's called stranger originated life insurance, also known as STOLI, S-T-O-L-I. That's another example of life settlement, but that one is illegal. The other ones are legal as long as it's done correctly. All right, any questions, comments on life settlements?
None in the chat.
Okay. All right, then let's talk about settlement options at death. Of course, a lump sum can be paid out, and that's a very common thing, lump sum. Sometimes maybe the beneficiary doesn't need the death benefit right away, or doesn't know what to do with the death benefit right away, so the death benefit could stay with the insurance company temporarily while the beneficiary figures out how or when to receive the death benefit, and then only interest is paid out to the beneficiary if it's interest only. But remember, that's only a temporary situation. Spendthrift clause, ever hear that? Spendthrift clause. So to understand what this is, we need to define the word spendthrift. A spendthrift is somebody who spends money foolishly, right? So suppose that I'm insured in my policy, and I have a young adult that I want to be the beneficiary. I might make sure that my beneficiary, my son or my daughter that's an adult, that maybe I want that person my child to get the death benefit a little bit at a time, not all at once. Not all at once. So that's what we mean by spendthrift clause. It's possible to have the death benefit paid out a little bit at a time instead of all at once, because otherwise it might be gone in a short amount of time. Fixed period installment is a type of a settlement option at death. This is where the beneficiary chooses the period. Like, I want the death benefit to last for 5 years. So it'll be 60 monthly installments that will last for 5 years. One moment, I'm going to get a drink of water. Right, so fixed period is the death benefit paying out in installments, but the beneficiary picks the period, and then the insurance company will calculate with the death benefit plus interest how much will be paid out each month. Fixed amount is similar, but with this one, fixed amount, the beneficiary picks the amount. Like, okay, I want $1,000 a month, or I want $3,000 a month for however long it lasts. So the beneficiary picks the amount, and then the insurance company calculates how long the payments will last, how many monthly payments we paid. Life income means that the death benefit is essentially turned into annuity. So the annuity that's been annuitized, I should say. And so then the beneficiary will one of the options under life income is to receive income for as long as the beneficiary is still alive. And then with income tax consideration, so lump sum, remember, with lump sum, it's going to be tax-free. No income tax on a lump sum death benefit. But these other ones, like fixed period installments, fixed amount installments, life income installments, that's there are going to be income tax considerations there, because when a person is receiving an installment payment from a life insurance death benefit, most of it probably is going to be the original death benefit that's being paid out, but some of it is going to be interest. So the interest will be taxable because it's a investment gain. All right, any questions on the settlement options at death? What's from your experience, those of you that have sold life insurance and have had insureds that have died, what's the most common one that you've seen?
So John, you mentioned so the income for the client that choose the they put the back benefit to the lifetime income. They have to pay taxes, certain taxes on the gain, right? Because the back benefit is supposed to be tax free. But if it's a long term, like the income stream, and then they still have some tax issue, right?
Yeah, so it's my understanding that if if there's the death benefit is paid out in installment payments, since the death benefit is not paid all at once, and the insurance company is getting to keep the money, or a big chunk of it is paying out a little bit at a time, the beneficiary is entitled to interest, and that interest is taxable. That answer that question, or did I misunderstand the question?
Yes. So I understand that the interest is taxable. The thing is about if they put this death benefit to the the annuity lifetime income, and then do they have a tax issue?
I'm sorry, I didn't quite follow that. So if they do what, then I understood that you're asking if,
Okay.
if something happens,
So,
that you're asking if there is a tax consideration. Go ahead.
yes. So usually the death benefit is tax free. So certain circumstances, then they have like a tax if they have their assets they have too much money there, but if they put the death benefit goes to a lifetime income annuity, so do they still have some like taxes they have to pay, or it's all tax free?
Yeah, so it might depend upon some various factors, but generally, if they put it into an annuity, are you saying you're actually buying an annuity? Is that what you're saying? Is like, can we take death benefit and buy an annuity?
Yeah, it's kind of like a non-qualified annuity, right?
Yeah.
So
there could
even
okay. I think I understand. I think I
Mhm.
understand the question now. So yeah, so like if it's a non-qualified annuity, there's no non-qualified money is being put into the annuity, and like a death benefit amount, that would be considered non-qualified money that's turned into an annuity. Yeah, that annuity is going to generate income, and so when a person is receiving a annuity benefit of annuity that's been annuitized, yes, and it's non-qualified, some of it is going to be considered interest, some of it's going to be considered return of the original amount put in, and so any gain it's going to be taxable.
Okay, thank you.
Thank you.
Uh-huh.
All right, now let's talk about final expenses. So final expenses. Final expenses are simply the expenses that need to be paid upon a person's death. Of course, is what final expenses are. We all know what that is. And then what about typical final expense amount? So I do have some information for you that I can share with you. One moment while I find that. So I'm getting this information from a news release put out. So I figure that any information on a news release is fair game to use. So this news release is from the National Funeral Directors Association, and it's telling us the cost of funerals on average. So this one right here is, let me know if that's too small to see, but it's saying the national median cost of an adult funeral with viewing and burial. And so this column here is the 2001 number. That's the latest numbers that they have, which is this news release was about just a little bit over a year ago. It was at the end of 2021, which is relatively recent. And it's saying here that the median cost of a funeral with viewing and burial is $78.48, but then there's also the vault, and then that's another $15.72. So this is the number that they're really coming up with here, is the $9,420 would be the median cost of a funeral with viewing and the burial. That doesn't include some other things like the cemetery plot. It doesn't include the grave preparation, like the digging with the excavator. It doesn't include obituary, the newspaper obituary fee. Doesn't include flowers and the funeral potatoes. So this would be what the funeral home, the average amount that a funeral home would charge. Any thoughts or questions on that? Is that some of you maybe had to be involved in paying for a funeral recently? Is that seem reasonable from your experience, or that's too low or too high based upon what your experience?
It's low. It's low.
Too low?
Mm-hmm. Well, there are a couple of discount warehouse funeral homes around. Serenacare, Aspen Funeral Services. They're discounters, but if you already own your plot, you need to plan on 11 or 12,000.
Okay. All right. So yeah, and different areas have different prices too, but that's the national average. And again, it doesn't include a lot of the other things that are necessary, like the digging and the preparation of the grave and the flowers, the meal, and so on. Yeah, I think so. Both my mother passed away. My mother passed away a few years ago. My mother-in-law recently passed away, and yeah, I think it was, with everything, it was around 12,000 something, including the meals and that kind of stuff. All right.
If you buy a cherry wood casket, it's going to be a lot.
Yeah. Gold plated. Gold lined.
I think it was.
All right. So it's always a good idea for funerals to be pre-planned. Those are called, it's called pre-need. And so, I just mentioned recently that my mother passed away, my mother-in-law passed away, and they both had pre-planned their funeral. And that was a good thing. It was certainly good, because then when the time came, then everything was already picked out. We didn't have to, I didn't have to have a discussion with my brothers as far as what was needed. And my wife's from a family of 10 kids, and they all have strong opinions on, mom would have liked this and mom would have liked that. So having the funeral planned out ahead of time, of course, is always, I think, a win-win situation for everybody. And so, of course, that can be done at the funeral home. The funeral director will gladly meet with the person to discuss the options, discuss the choices that are available for the goods and the services performed by the funeral home. And then, of course, big decision is burial or cremation. And, it's no fun for family members to lose somebody, but then also have to stress over, not sure, Did she want to be cremated? Did she want to be buried? I don't know. And the surviving family members might be arguing about it. That's not good at all either. So big fan of pre-planning funerals, also known as pre-need. Anybody have any comments or thoughts on that from your perspective? Crickets? I'm hearing crickets.
Chats are crickets too.
All right. Want to get her done, right? So, all right. So ways to pay for final expenses. So we'll talk about that in just a moment. The different ways to pay for final expenses, some different strategies. But first, according to a recent news release by the National Funeral Directors Association, what is the national median cost of an adult funeral with viewing, a vault burial, not including non-funeral home services and fees, such as cemetery, grave preparation, grave marker, funeral, meal, flowers, obituary, probate, and so on? So what's the cost without all those things? According to the National Funeral Directors Association, anybody remember the number that I threw out at you?
Nathan,
94.
Jana,
It's
they're all saying 2. Yeah.
Yep, $9,420. You never know what you need to know. Okay. All right. Any questions there? All right. So now let's get to the meat and the potatoes, or the sushi. If you don't like meat and potatoes, if you don't like sushi, I don't know, tofu. So here's some important information, as it relates to you being an insurance professional. So we should talk about what a funeral trust is. So a funeral trust is, specifically money set aside to pay for a funeral. And there can be revocable funeral trusts. There can also be irrevocable funeral trusts. And we should know those words. Revocable means changeable, of course, and irrevocable means not changeable, cannot be changed. In other words, somebody puts money into a funeral trust and you can't undo that decision if it's an irrevocable funeral trust. So funeral trust allowable expenses are going to include, all those things that we talked about, whatever the funeral home charges can go into the funeral trust. Whatever money can be set aside for the funeral services, funeral home services and goods, that could go in a funeral trust, as well as like the cemetery cost and the grave preparation cost, and it can also include like the meal afterwards, the obituary, the flowers, all that. So in Utah, and most states have, the idea of Medicaid eligibility. And so, the idea, of course, with Medicaid eligibility is that in order to qualify for Medicaid, a person has to essentially run out of money, right? A person has to be impoverished in order to qualify for Medicaid. And so it's important to know, I think, that we should know what an irrevocable funeral trust is, or how that comes into play with Medicaid eligibility. So most states have an amount that can be set aside into an irrevocable funeral trust, and Medicaid can't touch it, right? So if I'm in the nursing home, I've run out of money, and now, my money's all gone. It all went to the nursing home. And now what? There goes my money for my funeral. Oh, dang it. Now I don't get a funeral. But you can set aside money into an irrevocable funeral trust. A person can set up an irrevocable funeral trust, which protects the money when qualifying for Medicaid. Okay, so different states have different amounts on that. Most states, the limit is $15,000. You can put up to $15,000 into a irrevocable funeral trust. and that can be protected from when qualifying for Medicaid. In Utah, anybody know what the amount is in Utah?
I saw $7,000.
Yep. It's $7,000 is what you can put into an irrevocable funeral trust in Utah. It's something, at least something can be protected. So a person is guaranteed to have some kind of funeral. But in most states it's 15,000. So let's talk now about more details about how life insurance comes into play. And so I got some ideas here. All right, so here's just some ideas that I put together as far as ways to pay for final expenses. So option number one, here it says, let the surviving family members figure it out. Would that be a great idea? No, of course not. Of course, we don't want to do that. We don't want to let the surviving family members figure out how to pay for it. Not a good idea. Second one, it can be paid by savings. So I can open up a savings account at the bank or credit union, and it can be a payable on death account. And so that can be paid, it's kind of like a beneficiary, same idea as a beneficiary in a life insurance policy. Payable on death account just means that I can name the funeral home as the beneficiary, if you will, of my savings account. So I die, and the credit union or the bank gets the death certificate. They'll pay the amount in the savings directly to the funeral home. Okay, but there's a disadvantage of that way of doing that, is because creditors could take that money, or if I run out of money, it's going to go to the nursing home if I'm in a nursing home, and so not a real good idea. And what if the funeral home goes bankrupt? What if I move before I die to a different city and different funeral home? So not a real desirable way is paying with savings. So then there's pre-need planning with the funeral director. So I can go to meet with the funeral director. The funeral director could set up a funeral trust without life insurance. In other words, I just write out a check to the funeral director, and it goes into a trust, into escrow account, really. And then a disinterested third party handles the money, and then when I die, then the money can be used for my funeral. So a pre-need funeral trust set up with the funeral director can be set up without life insurance. It can also be set up with life insurance, with whole life insurance. And in the case of my mother-in-law and my mother, they both did this option. They both went to a funeral home. The funeral director had in both cases, they were different funeral homes. Both cases, the funeral home had an insurance license. The funeral director had an insurance license, and sold each of them separately a whole life insurance policy, specifically to pay for the funeral. The beneficiary was the funeral home. It went directly to the funeral home when they died. Which I'll be honest, it worked out really well. It really worked out well with that situation. The funeral home took care of everything, and so this is your competition. I'm just letting you know what your competition is, because a lot of people go to the funeral home, buy the life insurance directly from the funeral home. But how can you come into play? So another way to pay for funerals is life insurance from an insurance agent like you. You can sell somebody a term life, a whole life, universal life, or all three, and that can pay for the funeral. A trusted family member can be the beneficiary, get the death benefit, and pay for the funeral. One potential disadvantage of that method is that some insurance companies might take a few weeks, might take a couple months to get the money. So maybe the funeral home wants the money sooner than that. So got to watch out for that one. If the money's not specifically earmarked for funeral, it might take a few months, especially if it's a big policy. Might take a while for you to get the death benefit. The second one, there's final expense policies, also called burial insurance. So those policies are kind of like regular life insurance, but they some of them might have cash value and some of them might not have cash value, but they're specifically earmarked to pay for funerals, and some of them are considered guaranteed issue, which means that just about anybody can get the policy, but some of them won't pay a death benefit if the death happens within 2 years of buying the policy. So got to be careful about those final expense burial insurance policies. They don't cost very much, but the death benefit isn't much either, and there could be restrictions, limitations on those types of policies. And if a person's over a certain age, like maybe 80 or something, or 85, somewhere around there, you might not be able to get that particular type of policy from a particular insurance company. And so I looked over, I was given a list of carriers that you may be appointed with. And so several of them do provide these final expense burial insurance policies. Just be careful. If you're selling those, just be careful. Know for sure. Be able to explain to the client what they're getting into, what the limitations, it only pays for a certain amount. Might not pay a death benefit if the person dies from a disease or natural causes, we say, within the first 2 years, or suicide within the first 2 years. Well, that's a normal thing with most life insurance policies, a suicide exclusion for the first 2 years. But these are unique in the fact that a lot of them won't pay a death benefit if a person dies from natural causes during the first 2 years. They will pay if the insured dies in an accident, quite often, but not from disease or sickness, natural causes. And then one more thing we're going to wrap her up here real quick is irrevocable funeral trust is something that I would recommend that maybe you want to check into, because that's your competition with the funeral homes. The funeral homes are they're selling these pre-need funeral trusts with the whole life insurance, and most of them are tied to an irrevocable funeral trust, which means that the money can't be taken away. So I don't know if you're appointed with any carriers that that tie the life insurance directly in with an irrevocable funeral trust, but it's something to consider, something to look at, because that's what the funeral home directors are selling mostly. And so I'll leave it with that. We open up for discussion on that, but I would really maybe encourage y'all to take a look at that option and see if the carriers that you're appointed with sell those types of policies, because I know there are some insurance companies that do sell that type of policy. That is, the life insurance is tied in directly in with the trust. All right, I'm going to wrap her up here. Any questions or comments for me? Doug, Nancy?
No, we've got some people saying thanks and great class, good information. Thank you.
Mhm. Thank you, John.
Thank you.
Thank you. Thank you, John.
Thanks.
So Terry, are you on the line?
Yes, I am.
Could you tell, is your voice well enough to tell everyone what to expect?
I'm going to be sending out an email, and you will need to answer the questions, and then it will come back, and we will send those probably Monday or Tuesday, maybe even Wednesday, to John and his wife, so we can get these taken care of for you.
Okay, and we know we're getting close to the time. We do have a dedicated life insurance department at Stonehill, and with some great people who can help you with most of these things. So if you need more information about that, certainly contact us. Lexi, are you still here?
Yeah.
Would you just give it, so Lexi is one of our life insurance experts. Can you just give a brief synopsis of your department?
Yeah. So just basically everything that John mentioned, we'll be able to handle term life, universal, index. We do not have a variable life license right now. So we have another department or division of our company that will handle those. But everything else we do offer, including the final expense as well. So yeah, if you need quotes, applications, you know, if you need to discuss clients, you have a hard case you're trying to work, myself or Jamie Phelps, she's the manager of the life department, will be happy to assist with any questions, concerns, anything like that.
Thanks, Lexi. And thank you all. You'll be receiving an email. If you want to stay on the line, we will be staying to answer any questions that you have. So thanks for coming very much.
Thanks, everybody.
Thank you, Doug.